Today I want to share some data science ideas for Enact Financial. They're a private mortgage insurance company headquartered here in North Carolina. And here's the scoop. With private mortgage insurance, their business is, hey, you don't have 80% to put down on our property. Okay, the bank's going to say, we need someone to back us up in case you foreclose. You pay this insurance company, they'll pay us. Even if you don't foreclose, you pay anyway. The benefit to you, though, is you'll get the home, or you can, with your existing down payment, you can get a larger home. Now, what's the scoop with Enact? Earnings have been looking great. We'll see Q4 earnings soon, but so far over the past year, they've been doing really, really well, which is odd because so much of their growth comes from new mortgages, mortgage origination. And what we've seen, rates are high, but home prices are still high, so go figure. Of course, origination is down. But interestingly, their persistence, their insurance in force amount, this is the opposite of churn, has hit record levels quarter over quarter because it's cheaper for a customer, instead of refinancing out of an FHA loan, it's cheaper to keep the PMI in the existing low rate, so that's what they're doing. Now this opens up two interesting opportunities, and I wonder, and in the insurance business, driving down operational costs has been the story from the very beginning, whether it's for mortgages or other things. You know, thinking about the old field rep model of the 1900s, the Geico State Farm. This is, a big push is always to reduce operational expenses. And when I look at the Enact website, their digital property, they are publishing a lot of PDFs and a lot of manuals and guides to the mortgage lender to help them go through the mortgage origination process, detect errors, get the correct information from borrowers. Right now, it's all documents, and they update these. It's a highly regulated environment, so PDFs are important, but there's no interactivity. There's nothing where a lender could come in and actually upload some information, at least presumably, and start getting some feedback on that application in real time, or at least some sort of static analysis. The idea here being, if you can help them get through this process faster, it's more likely you could increase the number of mortgages that you're going to service, more loans you could write. Now, that's obvious, I know, but I think the next step from this would be there's a tremendous amount of alternative data that's available. And this is the darling of fintechs, is to use alternative data to basically redo some aspect of finance. I don't want to touch that with a 10-foot pole. But I will point out that one publicly traded fintech, Upstart, has released a data product they call the Macro Index to predict mortgage default rates. They're using alternative data for this. So they're, instead of saying, hey, underwriters or risk analysts, we want to change what you're doing, let's go to sales and marketing teams that are interested in broader demand signal, and let's use some alternative data, like especially from this consistent customer base they now have, to say what sort of data products, what sort of signal can we find that will tell broader trends that mortgage lenders might want to know about, that realtors might want to know about. This could be their own, Enact Financial Index, Enact Macro Index, something like that as a potential revenue stream. And we could start to baseline this out with a series of reports that you just list on the website. Anyway, these are a few ideas. I'm very impressed with the earnings they've had so far, but amidst the the tough macro climate and the falling origination rates, it seems like a good time to take a look at Opex expenses, where data initiatives could help, and then also maybe as a new revenue source.